honestly, it can still work, is you give it to the eldest son. It's entirely up to the family. It's cooperation. But in our particular situation, it was the eldest son got the farm. My direct line got the one next door. Got a little help in purchasing that, and we kind of been there ever since. Let's see, I'm looking at my notes. So that's kind of the background. The most recent transfer, my grandparents were, I think, in their 60s, but no, their 80s, I'm sorry, when my father was very adamant about transferring the family farm to avoid those taxes, because it's going to happen. You can avoid it and put your head in the sand and pretend that it's going to happen all by itself, but trust me, it won't. And if you don't do it right, it can turn into a mess. So let me tell you a little bit about the process. You got to have common goals. The family's got to agree, because if the family doesn't agree, it can get messy, real messy. So having some common goals, including all the generations. In my case, and when we did this 20 years ago, my kids were just born. I was lucky enough that my grandparents and my parents, were alive, and we were all able to work together, along with my siblings and my cousins, all agreeing that, it's the family farm. We need to work together to get there. We were honestly very lucky. That doesn't happen in every case. Sometimes there's a lot of fighting amongst the generations. And if nobody knew this, Ashley, you got to pay attention to this one. Older generations don't always want change. They're very hesitant to change about anything, let alone transferring the most valuable thing in their life, meaning their farm or any other assets. So convincing the oldest generation, which they've got control, typically, you need to do something, takes time. In our particular case, and then you'll see it in this thing, we actually hired a tax expert with some psychology background. I'm not sure, one of those two. Brian and Barbara, you straighten me out on that one, whether it was sociology or psychology, to sit down with my grandparents and explain the need to do this. And it didn't go well. My father actually hired this guy to help us do this, and my grandparents weren't buying. So the process to doing the transfer actually took 5 years. And setting it up again with professionals, we used attorneys, tax attorney, big difference, by the way, ladies and gentlemen, a tax attorney versus an attorney and an accountant. It was a team of professionals to get this thing done, because it's kind of complicated. It's a lot of money. Brian can probably tell this story better than me. Farmland in New Jersey is probably the most valuable farmland, whether it's for farming or anything else. It's the most valuable farmland in the nation, unless you're on the beach in Hawaii. Right? So these are big dollars we're dealing with. So don't get cheap on professionals. It's going to cost you in the end. Go ahead, hire the professionals, be smart about it. I'm not saying just throw money at them, but professionals are good at what they do. I'm a big fan of professionals, whether it's accountants or attorneys or plumbers or electricians. They're good at what they do. There's a reason we have professionals. And when you're talking about something that's emotional, the farm, along with big dollars and the future, which is your kids and grandkids, is there anything more important than that? Don't cheap on the professionals. And to be brutally honest, in that document that I showed you from the SADC, that is one of the common things in those 10 stories. It was all about, they all went back to, you got to have the right professional. So it's not just the Sedams who are promoting this, it's everybody else that's done it right or done it wrong, have agreed you need to have the right professionals. Okay, checking my notes. Separating the land and the buildings, because it's real estate, it's kind of combined, land and separating that from the business. Because there's the real estate, which is where most of the value is, at least it was in our case, and the business. And the business could be your customer base, your equipment, relationships, whatever. Some of that's non-tangible, but the business of farming or retailing or whatever it might be, you need to separate the two. Get the land and buildings separated from the business. Now, in our particular case, what we did is I was doing all the farming anyway. There was an agreement amongst the family that Reich would continue to farm. He would operate the business. I got all the inventory, which is a couple $10,000 worth of hay and a little bit of equipment. And then the rest of the family became partners in the land. We developed a family limited partnership, an FLP. A lot of folks might be understand C corps or S corps or trusts or LLCs, which I set my business up as an LLC, but we set the land, the big chunk, into an FLP, a family limited partnership. And sometimes you'll get an attorney, they'll say, oh, the flip this and the flip that. I had to stop a guy one day. Go, what's a flip? He goes, that's your family limited partnership. I said, oh, okay. Attorney talk. So an FLP, which if I had to learn this, and the way a family limited partnership works is that everybody's a partner. In my case, it was me, my two sisters, my dad, and my 4 kids and 2 cousins, 10 of us. But the decision making in a family limited partnership goes to the general partner. And the general partner does not need to be the majority shareholder. It gets selected by the other limited partners. Who's going to be the general partner? Who's going to make those day-to-day decisions about the family limited partnership, about improvements to the property, maintenance, that kind of thing. So in our case, my dad, who put this thing in motion, he was the first general partner. So he did all the day-to-day stuff, and everybody else were limited partners. And depending on where we fell, I can go into too much detail here and I won't. Each of the 10 limited partners got a percentage share based on the lineage from my dad and my aunts and the kids, et cetera, et cetera. So there's a formula to that. I'm not going to bore you with it, but the day-to-day stuff is done by the general partner. Okay, what happens in this family limited partnership? Dad gets hit by a bus. Who's your next general partner? Well, in a family limited partnership, you need to plan for that too. In the event that your general partner is deceased, who's going to succeed? So you have a succession inside of succession. That's why it's kind of a test question, some of this stuff. So we developed a second general partner to take over in the event of my father's death, which happened. And that was an entity we created called Sudan Inc., which turned into 2 partners were one of my sisters and myself. So now we're kind of protected. There's 2 of us. And she and I are looking at each other now, because we're celebrating birthdays more often, that we need to create the next succession to Sudan Inc., who's going to be the next general partner. I hope you're sticking with me on this. I know it gets kind of wordy or messy, but it worked for us. And the professionals set it up. It took me a while to learn it all, but the professionals set it up, and it worked out really well. Here's the next part of that. Still, a lot of the value was held by my grandparents. They're still around. We've set up the family limited partnership. We set up the percentages, but they still had the bulk of all the value. How do you move it from grandma and grandpa to their son and to all the grandkids without triggering huge tax impacts? Well, it's gifting. It's annual gifting. It's part of the tax code. You can do it. Back then, the limit was $10,000 from, in this case, my grandfather and grandmother, to any one of the limited partners, because there were children and grandchildren, tax-free. So there was no tax impact. So it was $10,000 per, and they were a couple. So that was $20,000 to each of the limited partners per year. And they did that over 18 years until my grandmother passed away, and then a couple of years later, my grandfather. So there was continual gifting that moved that value through the family limited partnership to avoid inheritance tax, estate tax, et cetera, et cetera. The good news is that limit is now $15,000. Now, under inflation, how much, Brian, you answer this one. Are we that much further ahead? I don't know, but the number at least sounds good. So now it's $15,000 per person down, into the family partnership, into the family. So if grandma and grandpa are still alive, that's $30,000 a year to each of their heirs, members of the general partner. And you can skip a generation, by the way. You don't have to give it from grandpa to dad to the grandkids. You can go right to grandkids and skip some of that paperwork, if you were. And my father was fine with it. He understood the goal of getting it from one point to another, and he didn't need it. He was still a general partner, and the family had a great relationship. We were blessed. When you read this thing from the SADC, and some of the families that were not so blessed, they went to blows at times on how to get this thing down to the next generation. Let me just point out in all this, when I back up a little bit, when I became, we separated the land from the business, Sedam Farms LLC, which is me, sole member, which is a real thing. You think of an LLC as a partnership, which is technically in the tax code, it is, but you can have an LLC a sole member partner, which happened to be the way we set it up. So I was a sole member, Sedam Farms LLC, and I became a tenant. Sedam Farms LLC became a tenant on my own farm because I own a part of it, not that much. I own a part of it, but my sister and my cousins and my kids far own more than I do individually. So Sedam Farms LLC, the business part of this equation, remember we separated the land from the business. I am a tenant. The entity, Sedam Farms LLC, is a tenant on the same farm that I own a part of. Not that wild of an idea, but just to point out that's the way you kind of explain it to the other members. So I pay a rent back to the family limited partnership so I can continue to run the farm in the same place we ran it before. You guys with me on that? Did I explain it right? Yeah. So, and I still do it today, although I'm a bigger shareholder than I was before because of some additional gifting and some inheritance. My sister passed away, as well as my parents, so their shares ended up coming to me, but I'm still a tenant as part of the family limited partnership, and it's working out well. All my cousins and my sister and my kids all understand that Wright's doing the work. So I have let's put it this way, a favorable rent to keep operating the farm. All right, I'm getting close to the end. Let me check my notes. Professionals, I did that. Separate older generations. Here's a big part. Also a very common theme in this thing from the SADC, preservation. Now, whoever listens to this in the future, and Ashley, whoever you share it with, and I'm sure Barbara's going to mention it too, preservation was key. Because everybody wants, I don't care how close your family is, we all like money. So being able to use preservation, and which we are blessed here in New Jersey, back to being blessed, as being the most proactive preservation state in the nation. We preserved the farm, landed with a chunk of money. Talking about taxes, that's always fun. The preservation, they hand you a check. They go, oh, just kidding. We want 20% of it back because of the capital gains. So you live with that. You say, yes, I preserved it, but we've had this land since 1840, so our basis was 0. So we ended up paying a 20% capital gains. So the government gave us money, and then we gave 20% right back. But we're going to have to live with that. But that preservation gave us the opportunity to make a distribution. Keyword in preservation. Distribution, whether it's in a lump sum, whether it's annually or both. You can do it in chunks at the beginning and then do an annual distribution, which is what we normally do at Sedam Associates. That's the name of our family limited partnership. So that preservation settles a lot of concerns. Beginning of this, I talked about family getting along and having a common goal. They want to keep it as a farm forever. We like living here. It's beautiful. We're proud of what we're doing for the planet, the environment, whatever you want to say. But everybody still likes getting a check. So by putting it in preservation, it gave us the cushion. I don't know if that's the right word. It gave us the comfort level. There you go. Gave us a comfort level with my sisters, with my cousins, and ultimately my kids, that all get a check once a year as a distribution, and everybody's great with it. So transferring the family farm can be complicated. There's a lot of emotion involved. There is a lot of money involved, as I pointed out at the beginning, especially in New Jersey with land values, what they are. So maybe I should have started with preservation, because then the rest kind of falls into place. But that's not the way it worked with us. It kind of went the other way around. So think about it that way, is get along with your family, have a common goal, talk about why you want to do this, when you want to do it. And by the way, don't wait till people start dying, because then it gets harder. Keep those professionals in mind. Again, I'm going to name 3 of them: attorney, tax attorney, and accountant. They're worth it. Separating the business from the land also made it simpler, especially in tax purposes. Developing whatever entity fits you, and those professionals are going to tell you which entity works for you. Gifting is very important. I'm 61, and I am going to start gifting probably next year. My kids get it. I may have to set up a trust so it doesn't get burned up too quickly for them to have it at a later time. And then ultimately, again, that preservation makes things so much smoother, knowing that there's some dollars there, so that anybody that's not living on the farm, close to the farm, enjoys the farm. They may live in another state, but when they get a check twice a year as a distribution, oh, that transfer is not such a bad thing. So with that, I think I've soaked up about 25 minutes. You've been very patient with me. Ashley or anybody else has a question, I'll try to answer it. Again, I'm not an expert at this thing. I just know that what we've done, and it worked. Again, some blessings that everybody got along during it. And I honestly have to start doing the next step. Well, I'll tell you this, the way we have it set up, if something happens to me tomorrow, it'll already happen. Due to wills, by the way, maybe I should have included that in some of the documents you need. Everybody should have a will as where this stuff is going. So I'm in pretty good shape, but to avoid, luckily, by the way, the Biden administration pulled out all those tax changes in the upcoming bill. So our exemption levels are going to stay where they are for now. So I'm okay. But you never know, that could change. So think about getting this done, getting it gifted down through the generations. And with that, I'll shut up and take any questions you might have.
I do have questions.
Shoot.
You talked about the professionals. I guess it's a two-part question. How did you go about looking for the professionals? And did you feel that they needed to have any ag background? Or out of the three that you mentioned, like the attorney, tax attorney, and accountant, was there one in particular that needed to have the most ag background?
No, there was no ag background needed. Agriculture is business like anything else. We like to think we're special, and we are, but we're business. But it is the family component. Do they work with? Do they have a history of working with family business? That might be a good way to look at it.
Yes.
Family business, and understanding. We're all in New Jersey right now. Are they understanding New Jersey tax code, how it impacts, which they should, if they're in the business, they should know it. So ag, I think your question was, is ag background essential? No. And I take that, well, no, it's not essential. It just happens to be that our family accountant grew up on a farm. He became an accountant. So he's very comfortable with us. The tax attorney I mentioned, no, had nothing to do with agriculture, but he worked with lots of family businesses. Not necessarily in a transition mode, but he worked in business tax law. And our attorney was our family attorney who knew us inside and out. To be honest, that tax attorney was the most crucial component of the whole thing.
Yeah.
Everything kind of pivoted around him. He was the point person. They all coordinated. They didn't do it in a vacuum. They all worked together. Probably I should have included that, is you don't want them arguing with one another, because then they're just burning billable hours. But no, they all work together. So to answer your question, ag specific, not a necessity. And by the way, Ashley, New Jersey, that's gonna be hard to find. So think about someone that worked with family business. You just unplug manufacturer and put in farmer, and I think you got the whole thing. Anybody else? I'm sorry, this really works. So our professionals on the Zoom call, if you haven't seen this from the SADC, it's easy reading. It's not hard. There's a couple of horror stories in here, and you go, thank God that wasn't me.
Yeah.
That's what I'm saying. So this publication from the SADC, again, what is it? NJ.gov agriculture/SADC publications transfer.
Yeah, I put the link in the chat there, right? So
Okay.
people can just click on it.
Yeah.
Okay, well, the reason I didn't try to put this up, because I'm not real tech savvy nor PowerPoint. It's 37 pages. So you guys didn't want to look at 37 pages on a screen.
No, thanks, Frank. Ashley, do you have any other questions, or Brian?
How are you on time, Madeline?
Oh, we're good. Yeah, we're
Okay.
good.
Then I'll just ask, pardon me, one, Reich, first of all, I agree with you about the liquidity of getting that easement payment to help with estate claims and not having to sell off acreage to meet those estate claims. You know, that's a good advantage. When you talk about the gifting and the distributions, are those gifts from an individual to an individual, or is it a legal entity to a legal entity? For example, I think the question you understand.
No, best of my knowledge, it was individual to individual.
Okay.
It's a good question. I'm not sure I'm right, but I know that it was directed from an individual to an individual partner of the family limited partnership. So I think that's one-to-one. again, the professionals took care of all that. You pick up the
Yeah.
phone and said, you know, grandma and grandpa and I grandma and grandpa want to send $20,000 this year to each of our 4 grandchildren. And they made it happen out of the magic of accounting. That's why we paid those guys to make it work.
Mhm.
Okay.
Okay, all right, thanks, Rick. So hey, Barbara, we'll have you come on. Barbara's you good there, Barbara?
Yeah, I'm just about to put up the slides and
Okay.
share my screen. And let me know if you can see them now.
Okay, looks good, Barbara.
Okay, great. So I'm just going to add a little bit about personal finance and how that kind of goes into this whole process of succession planning. And as Madeline mentioned, I was the former financial management specialist for Rutgers Cooperative Extension, and I'm now a full-time financial education entrepreneur based in Florida. But I am doing some work with Rutgers too to keep up all of the websites and the materials that we have on our website. So just start out with a disclaimer. I may mention a company. I'm not endorsing any particular products or services, and I may be talking about some strategies, but if you want to actually put them into practice, you'll need to see your own legal or financial advisors to do that. So I thought I'd just start out with kind of a clip here. I don't know if any of you watch Succession on HBO. This is a very dysfunctional family. It's in its 3rd season on HBO, and they've got this company called Waystar Royco, and they've got 4 children and the aging owner, and they've been fighting over this now for a couple seasons in HBO. So I thought that would be kind of an example of how you don't want to do succession planning. And I happened to be reading the Journal of Financial Planning yesterday. And one thing about financial planners, they're very similar to farmers in one way. They're an aging population. And financial planners are having as much difficulty as many farmers do with the succession process and handing over their business to either the next generation or another suitable partner. So I wanted to put these quotes on because I think they're very applicable to agriculture too. Sometimes owners just can't let go. They won't introduce their successor to their clients or change anything in their business to facilitate the transition. They'll just say, okay, successor, you are here until I die, and when I die, you can change things. That may ring a bell. It's not uncommon for the exiting business owner to push their retirement deadline further and further back. So you think they're going to exit, and 20 years later, they're still running the farm. And then they went on to say in this article that it's important to understand the perspective of the person who's exiting. And what they really said is that it's all about feelings, and that they need to feel, okay, I can afford to retire. The sale price of the business is fair, and I have what I need to provide for me and my spouse. So I thought that was just kind of an interesting parallel to what many people in agriculture are feeling. So basically, I have about 10 minutes or 20 minutes to give you 10 tips related to the personal finance aspects of succession planning. And I think I would start exactly where Reich did. Is I think it really starts, the first place is the family conversations. And this is where you really have to discuss your hopes and fears openly. I can remember that when we did some focus groups with farmers in Sussex County as kind of a background for the later life farming course that we developed, and I'll talk about that a little bit later, we asked them a question that the answer always struck with me. We asked them, what is your greatest fear? And I'll never forget, one of the farmers said, my greatest fear is that my children won't talk to each other after we're gone. And that really stuck with me because, I mean, that was just a visceral kind of emotional thing. So families really need to get these kind of conversations out in the open. Sometimes the best way to hold difficult conversations is to use I statements, because with an I statement, you're expressing feelings, you're not blaming anybody, you're not using the word you, like you did this or you make me feel like this. It's from your perspective. So I'll give you some examples. I am worried that we will owe a lot of taxes. I'm afraid that you children won't speak to each other after we're gone, you know, putting it in those terms. And then once you start talking about the emotions, you can start talking about options as well. And of course, some of the things that you'll need to be discussing is, what is the value of the farm? How are we going to get a value on it if somebody's going to buy you out, for example? Or if the gifting of farm stock shares, or just the gifting like Reich talked about previously. And then also the plans for the older generation to do what you might call letting go and having a lesser role in the management of the farm. And then the whole issue of fairness becomes so important among siblings. You know, that you may have some siblings who are going to continue the farm and others that have no ties whatsoever to the farm. And that's a big issue. And then another issue that really came close to the fore when we did that conference a few years ago, Rutgers Cooperative Extension, I think it was in 2016, we had a full day conference on succession planning. And one of the workshops that we had is getting to what is the ability of the farm to support multiple families, multiple generations. And that often involves some of the techniques that we heard from the keynote speaker to just kind of ramp it up and get more business so that you have more resources to support multiple families. So these are very sensitive conversations. Some people may want to bring in a third party to kind of lead the conversation. Perhaps one of those attorneys might have a mediator that they might call in. So it's really important to have those conversations, because you can't really do anything else until you get agreement among the family as to where you want to go in the farm transfer process. Once you've got that kind of established, and it may not be totally fine-tuned, it might be what I guess they're referring to down in DC these days as the framework. You know, you don't have every detail ironed out, but you've got some agreement about general concepts. Then it's time to contact those advisors that Reich was talking about. The tax attorney, the estate planning attorney, the CPA, and others that you might be working with. And with that person, you'll be telling them what the family has been discussing and their wishes, discussing the estate planning strategies, preparing and or revising legal documents. I mean, hopefully farm families have had these legal documents, a will for sure, in place for a long time, but at some point you may need to do some revisions. And then, of course, all the legal documents that are specific to the transfer of the farm. And I totally agree with what Reich said, is this is the time to hire people who are competent and to not pinch pennies, because it could come back to bite you later. The other thing as a financial planner that I kind of want to recommend is just making sure that anybody in agriculture at any age, whether you're listening tonight and you're in your 30s, 40s, 50s, 60s, or whatever, have some retirement savings accounts established. It's not wise to count on the farm alone for all as a major or only source of your retirement income. So throughout your working years, you have the ability to set up various retirement savings accounts. So either a Roth and or a traditional IRA. And the limit is $6,000. a year that you can contribute if you're under 50, and an extra $1,000 if you're age 50 plus. And the IRS just announced the limits for 2022 today, and there is no change for 2022. So the same limits for the IRAs. Taxable accounts. So these would be accounts that are not in a retirement savings plan, but you might open up a mutual fund, maybe with a low cost index fund, for example. And then annuities. These are contracts with a life insurance company, and you want to look for ones that have low expenses and also a highly rated insurance company. And then many farm families have off-farm jobs. Either the spouse or the farmer themselves may have an off-farm job. So then you have access to the plans that are available through that employer, like a 401k or something of that sort. Okay, number 4 is to set some goals for the future. And this is particularly important for the older generation as they start thinking ahead as to what they want to do. And you might want to have personal goals and then also business goals as well. And whenever I teach goal setting, I always share this template with people because I think it's a really good way to get your goals down on paper. You say, I want to, and then you describe whatever the goal is by and have a certain deadline. And then so I will is where you describe the action steps to reach your goal. So if the older generation wants to maybe step aside from, full-time management of the farm, and they specify a date, and then describing the action steps that would be needed to make that transition a reality. So setting SMART goals is just really important. And when people are younger, their goals are what they call to retirement goals. And then as you get older and you're transitioning away from full-time work, then you're starting to look at through retirement goals. And both types are important. Okay, another thing that all financial planners recommend is that you keep annually updated financial statements. And this will become even more important as you get closing in on a transition from one generation to another. So the two basic statements that financial planners use with clients and people can do themselves, and we have all the tools that you need on the Rutgers Cooperative Extension website, are a cash flow statement, which is your income minus your expenses, and then your net worth statement, which is your assets minus your debts. And we have templates on the website for both of these. We have them either in paper and pencil form, or we have Excel templates that you can download and put on your own computer. All the functions are built in, all the mathematical formulas. You just have to plug in your own numbers. And once you do that, it's very easy to update them from year to year. I do my net worth statement every year. It probably takes about an hour because you got to look up the values of different things, the current values, but the template is in place and it makes it really easy to do the updates. So this is going to be your snapshot of your finances, and this is going to be really important as a planning tool year to year, just to see how you're progressing toward your goal of having financial independence for the older generation of farmers. And then it's really important to diversify investments. And, the old saying, if you don't want to have all your eggs in one basket, and how financial planners usually recommend people do this is to set what they call asset allocation weights. And these are the percentages of your overall wealth, if you will, that are held in different types of what they call asset classes, like stocks, bonds, real estate, and cash equivalent assets. Might be things like money market funds or certificates of deposit, for example. Now, for a lot of farm families, the real estate might be more than the 20% that's shown on the slide here. But it's important to kind of know how your investments are breaking out among those asset categories. And then typically what you want to do is rebalance your portfolio periodically. It's a good idea at least once a year to take a look at your portfolio. This year, the stock market has done very well. I just put together a webinar that I do every year that's an annual review of personal finance events. And we started out the year with the Dow Jones Industrial Average at 30,000 and change. It crossed 36,000 the other day. So people's stock portfolio percentage is probably larger than their target asset allocation at this point. And you'll want to rebalance that portfolio. And people can either rebalance by selling things, which is great to do in a tax deferred account because there's no tax liability, or you can rebalance by putting new money into the underweighted asset classes. So if your stock percentage has gone up, you might put more money, let's say, in bonds or cash equivalent assets to balance it back. So it's all kind of math. And then some of the key factors that go into setting your asset allocation are your age, your investment risk tolerance, and your investing knowledge and experience. And there's a tool on the Rutgers Cooperative Extension website. I'll show you exactly the resource in a few more slides, where you can take an investment risk tolerance assessment. And it's on a website that's housed now by University of Missouri Extension. Another thing that financial planners talk a lot about with respect to older adults and planning for retirement is the whole concept of buckets for whatever amount of money that you've set aside. You've got a short-term bucket, a mid-term bucket, and a long-term bucket. And the way to visualize this is that your short-term, this is kind of your emergency fund. And this would be your short-term needs, maybe within 3 years. And you're generally going to want to keep this in cash assets. And then midterm, people might look at bonds. This might be a few more years out from the first bucket. And then longer term, this is money that people might decide to just keep in equities and stocks or stock mutual funds, because this might be money that you won't be touching maybe until your 80s. So you set it aside, let's say in your 60s, and have, if you exit the full-time management of the farm and you're starting to draw down on your assets, you won't be drawing down on bucket 3 for quite a while. So that gives you possibly 1, 2, even 3 decades to have that money be growing at a much faster pace, at least we know from history, than if you were getting cash assets that are not paying very much these days. So that kind of strategy is really important too. So if this is sounding a little unfamiliar, this is where you might want to hire a certified financial planner and have that person be part of that team. So along with the folks that Reich has been talking about, also have somebody who can run various scenarios on their calculators and spreadsheets and give you a good indication of what assets should be placed in which of these buckets. And then it's important at all times in life to have adequate insurance. But it becomes particularly important in succession planning because you want to make sure that everybody is covered for the various risks that they're going to be incurring. And also having the older generation that's maybe stepping back from the farm, making sure that they have adequate coverage too. So of course, you're going to want to have adequate property insurance. And that would be, your auto and your homeowners or renters insurance. Insurance on the business property. Umbrella liability. As people get older, they're more likely to be sued because older people have more wealth than younger people. And particularly farmers, when you think of the land exposure and people trespassing on property, you never know what's going to happen. So as you build wealth, you'll want to have umbrella liability insurance. And you can basically get about $1 million of coverage somewhere between 300, 350. And then maybe add another million or $1 million increments, maybe for 200, 250. I mean, you'll have to shop around, but that would be a general range of cost. And then, of course, if there's a need for life insurance, and life insurance often comes into succession planning, because if you have different people on the farm, just like business owners do in the corporate world, you may purchase life insurance on each other's lives, so that there's a pool of money if like, let's say the surviving spouse of a person on the farm has passed away, that there's liquidity. So farmers may have more of a need for life insurance at an older age than others would be. Typically people kind of phase it out when their children have gotten older. But when you have liquidity needs related to a business, you may want to continue life insurance for a long time. Disability insurance, as long as people are working on the farm, it's really important to have disability insurance, because farming is one of the occupations that has the highest disability accident rates of any that are out there. So make sure everybody is covered in that way to provide income if they're unable to work due to an accident or illness. And then, of course, health insurance becomes really important. And whether you get it through Farm Bureau or Affordable Care Act or whatever your source is, you want to make sure everybody has adequate health insurance. And as the older generation transition, they, of course, will be covered by Medicare. And you'll probably want to be looking for a supplemental policy. I highly recommend the SHIP program. Every county office on aging or division of senior services, whatever they call it in your county, has a SHIP program, State Health Insurance Assistance Program, and these are trained volunteers who can help older adults find a Medigap policy that's licensed in the state of New Jersey, or whatever state you're from, if we have any visitors tonight. And then also make sure you have a long-term care plan. Doesn't necessarily have to be insurance, but this is another thing that families want to think through, is what are the plans and what are the assets that could be set aside if somebody needs long-term care services. So that's really important too. Okay, I mentioned that I would mention Rutgers Cooperative Extension resources. So you've got the link on the slide. There's a lot of resources there. The spending plan worksheet is great for preparing a budget or a spending plan. So again, you're looking at your income and your expenses. You can also use the spending plan worksheet to track previous income and expenses. So you can do it as a future projection, or you can use it as tracking so that you get accurate numbers to put a budget together. The net worth calculation worksheet is up there too. And we actually have two versions, the Excel version or the paper and pencil downloadable version. Another really good worksheet that is on the website is beneficiary and personal representative designation. So it's a document where you can list in one place all the beneficiaries that you have for life insurance, for if you have a 401k from a non-farm job or an IRA. All of those documents have beneficiaries, so you can list them all in one place, which makes it easier to review them and keep them up to date. And also it has places where you can list all your personal representatives. Who is the executor of your will? Who's the contingent executor? Who's your healthcare proxy with your living will? All of those people. Another really good worksheet that's up there is the digital assets inventory worksheet. And it can take you, last time I did it myself, it took about 4 or 5 hours, because you're actually backtracking through your digital life and writing down all the passwords and the names of all your accounts and their passwords, username and password, and code, questions that you might have, got to get that all written down. And that just makes it easy for you to access your digital assets, whatever accounts you have to access, but also makes it easy for people who will be handling your financial affairs. And then there's a financial goal setting worksheet as well. And then the last thing I want to mention is the later life farming course that was developed by a team of faculty at Rutgers Cooperative Extension about 5 or 6 years ago. And I am planning to look it over next month to make sure that it's up to date for going into 2022. And there's 10 modules in the course. It also includes that document that Reich was talking about the case studies from the SADC. So I encourage you to take a look at that. There's also all the recorded videos from that conference that I mentioned that we had a few years ago. Those are all on the website as well. So I'll just end it here and see if there's any time we have for questions. I'll stop the share, and if there's any questions, be happy to answer them.
Yeah, we have about 6 minutes
Okay, great.
for questions. Yeah. Yeah, when I thought of how do you, when you're doing like your personal financial planning, how do you not mix your business in? Like, it gets a little tricky, right?
Yeah, it does. And, hopefully you have a business checking accounts. I mean, that's business management 101, is that you don't
Right.
commingle your personal
Combine.
life with your, there's actually some good documents. Iowa State Extension actually has a good net worth document that was developed for farmers, and it includes the farm assets as part of the net worth, but separate in a separate section. I'll see if I can find it while the other speakers are talking later, and I'll put it in the chat, because that's a really good tool, because it kind of commingles everything together so that you can see the totality of a farm family's wealth, but it keeps that farm piece separate if you want to see what your wealth is, with the farm assets and without the farm assets, if that makes sense.
Hey, Barbara,
Yeah.
you brought up a good point, which I missed, and it's kind of more in your bailiwick than mine. In the farm, in my particular case, it was linear, came to right. But if it's partners, if there's brothers, if it's brother, sister, whether it's farmer and sister-in-law, whatever it might be. He talked about life insurance. In the insurance world of things, there's things called a cross-sell agreement. So that
Buy-sell agreements, yeah.
Buy-sell. I said cross-sell, buy-sell agreement. So that if there are partners, doesn't matter what gender they are. My brother dies, now I got to live with my sister-in-law, who I like very little. So, but if I have an agreement in writing that says, hey, I'm going to have a life insurance policy on Donald, so if he dies, I have the money to pay off, Marilyn, so I don't have to work with her the rest of my life, because
Exactly.
she's not my favorite human being. So a buy-sell agreement funded by life insurance.
Exactly.
Can you expand on that just a little bit? You're better at that probably than I am.
Well, that's basically what it is. You're going to be seeing a lawyer and getting that drawn up among the parties that are involved, and then you would obviously be looking at valuations of the business, and that would kind of drive the discussion of how much life insurance to purchase. And then the life insurance would be purchased as part of that process. So again, another reason to get professional assistance to make sure that it's all done correctly.
Didn't happen to me, happened to be my plumber. There were two brothers, they ran the business. One of them, great guy, Jack died. But now the other brother is dealing with his widow and running the business. There was no funding mechanism to buy her out. That sounds terrible. I'm sorry, it sounded terrible. But he didn't have the money to buy out his now deceased brother's share.
Right.
So
Yeah.
across a buy-sell agreement, so that actually the two brothers should have paid life insurance on each other.
Mhm.
So if something happens, they don't have to deal with family that they really didn't want to deal with. And could you see that happening in a farm family? Maybe?
Oh, absolutely,
Oh,
absolutely.
yeah, I know that
Yeah,
does.
definitely. And that's what I was mentioning, that farm families have different needs for life insurance than, people who aren't business owners that don't have any, succession issues.
The
So,
buy-sell agreement could be funded by life insurance that the entity or the two partners pay for. So the event of a death, they're not in a jam.
right, exactly. It gives you liquidity, flexibility, and options, it's a stressful time when somebody dies. The last thing you want to do is have to compound it with all these financial issues as well. Well, I hope that was helpful. Looks like we're going to be
So-
closed
Yeah,
out
looks
in
like
about
they have
14 seconds.
Yeah.
Actually, in 11 seconds, if I may, right, one of the things that I'm really alarmed by is how few farms actually have good succession plans that are written and planned out.